Welcome to the exciting world of Forex, also known as FX. It stands for foreign exchange. This is the largest financial market in the world. Think about it like a giant global marketplace, but instead of groceries or clothes, currencies are traded here. Every day, trillions of dollars change hands in the Forex market. Yes, you read that right, trillions. This is more than all the stock markets combined. Businesses, banks, and even individuals participate in this massive market. The Forex market is open 24 hours a day, 5 days a week. Trading happens across different time zones, from Tokyo to London to New York. This continuous trading makes it one of the most liquid markets in the world. Whether you realize it or not, you've probably already participated in the Forex market. Ever traveled abroad and exchanged your currency for another? That's Forex in action. Imagine you're planning a trip to Italy. You'll need to exchange your US dollars for euros. You go to a currency exchange or your bank and make the trade. The exchange rate tells you how many euros you get for each dollar. This rate constantly fluctuates based on supply and demand. When demand for the euro is high, its price goes up. When demand falls, so does the price. These fluctuations in currency exchange rates create opportunities for investors. They aim to buy a currency at a lower price and sell it later when it's higher, profiting from the difference. This is the basic principle behind Forex trading. It's all about buying and selling currencies to capitalize on these price movements. Sounds simple, right? While the concept is straightforward, the Forex market is complex and requires knowledge and careful consideration. But don't worry, we'll guide you through it. Forex trading is not just about vacation money. It plays a crucial role in the global economy. Businesses that import or export goods need to deal with different currencies. They use the Forex market to manage their transactions and mitigate risks associated with currency fluctuations. Investors and traders participate in the Forex market to potentially grow their wealth. They analyze currency trends, economic indicators, and geopolitical events to make informed trading decisions. The Forex market offers a wide range of trading opportunities. You can trade currency pairs like the Euro-US dollar, the US dollar, Japanese yen, or the British pound Swiss franc, to name just a few. However, Forex trading can be risky, especially for beginners. The market is highly volatile and price swings can happen rapidly. This is where ETFs come into play, offering a potentially less risky and more accessible way to participate in the Forex market. Exchange-traded funds, or ETFs, have revolutionized the way people invest. They provide an easy and efficient way to access various asset classes, including Forex. An ETF is like a basket of assets that you can buy and sell on a stock exchange, just like individual stocks. In the case of Forex ETFs, the basket holds currencies. Instead of directly trading individual currencies, you can invest in a Forex ETF that tracks the performance of a specific currency or a basket of currencies. This simplifies the process and reduces the need for specialized trading knowledge. ETFs offer a more accessible entry point into the Forex market, especially for investors who are new to currency trading. They provide diversification, transparency, and lower costs compared to traditional Forex trading methods. In the next section, we'll delve deeper into how ETFs work and how they can be your gateway to the exciting world of Forex investing. Imagine walking into a supermarket. You see aisles filled with individual products, but you also notice pre-packaged baskets with a selection of goods. ETFs are like those convenient baskets for investors. An ETF, or exchange-traded fund, trades on a stock exchange. It holds a collection of assets, such as stocks, bonds, or currencies. You can buy shares of the ETF, just like buying shares of a company. ETFs offer instant diversification and transparency. You know exactly what assets the ETF holds and can track its performance. Let's peek behind the curtain and understand how ETFs work. ETFs trade on stock exchanges like individual stocks, with prices fluctuating throughout the day. The creation and redemption process helps ETFs track their underlying assets. Authorized participants, or APs, are crucial in this process. APs buy assets and deliver them to the ETF provider for shares. When redeemed, APs exchange ETF shares for the assets. This mechanism keeps the ETF's price aligned with its assets. Forex ETFs specifically focus on currencies, offering investors a way to participate in the foreign exchange market without directly trading individual currency pairs. These ETFs track the performance of a single currency or a basket of currencies. For instance, you can invest in a Euro ETF that aims to reflect the Euro's price movements against the US dollar. Alternatively, you could choose an ETF that tracks a basket of emerging market currencies, providing broader exposure to the Forex market. Forex ETFs offer several advantages over traditional Forex trading. First, they simplify the investment process. You don't need to open a separate Forex trading account or deal with the complexities of leverage and margin trading. Second, Forex ETFs provide built-in diversification. By investing in an ETF that holds multiple currencies, you spread your risk across different economies and reduce the impact of fluctuations in a single currency. Just like choosing the right ingredients for your recipe, selecting the right Forex ETF requires careful consideration. With a plethora of options available, it's essential to understand your investment goals and risk tolerance. Start by researching different ETF providers and compare their offerings. Look at the ETF's expense ratio, which is the annual fee charged to manage the fund. Lower expense ratios mean more of your returns stay in your pocket. Consider the ETF's tracking error, which measures how closely the ETF's performance aligns with its benchmark index. A lower tracking error indicates better performance alignment. Lastly, assess the ETF's liquidity, which refers to how easily you can buy or sell shares of the ETF without significantly impacting its price. Look for ETFs with high trading volumes, as they tend to be more liquid. Imagine combining the global reach of the Forex market with the simplicity and accessibility of ETFs. That's the power this duo brings to investors. It's like having the best of both worlds at your fingertips. Forex ETFs provide an unparalleled way to tap into the potential of currency markets without the complexities of traditional Forex trading. They act as your gateway to a world of investment opportunities, opening doors to global currencies with ease. Remember that Forex market we talked about? The one that operates 24 hours a day, 5 days a week, and trades trillions of dollars daily? ETFs provide a user-friendly on-ramp to this dynamic market. You don't need to be a seasoned trader or understand the intricacies of pips and leverage. ETFs do the heavy lifting for you, packaging currencies into neat tradable units. Currency ETFs work just like any other ETF. They hold a basket of currencies, allowing you to invest in multiple currencies through a single investment. Think of it as diversifying your investment portfolio across different corners of the globe. For instance, instead of putting all your eggs in one basket by investing solely in the US dollar, you can choose a currency ETF that includes a mix of currencies like the euro, the Japanese yen, and the British pound. This way you're exposed to a broader range of economic conditions and potential growth opportunities. If one currency weakens, others in the basket might strengthen, potentially offsetting losses. Currency ETFs offer a level of flexibility that's hard to beat. You can choose ETFs that focus on specific regions like emerging markets or developed economies, or you can opt for ETFs that track a broader basket of global currencies. Remember the old adage, don't put all your eggs in one basket? In the investment world, this translates to diversification, spreading your investments across different asset classes to reduce risk. Currency ETFs can play a vital role in diversifying your portfolio. By adding currencies to the mix, you're adding an asset class that often behaves differently than stocks and bonds. When the stock market zigzags, currencies might zag, potentially cushioning your portfolio from sharp downturns. This negative correlation between asset classes can help smooth out your investment journey over the long run. Diversifying with currency ETFs is like adding shock absorbers to your car. It helps you navigate bumpy market roads with greater stability and potentially a smoother ride. Section 4. Currency ETFs in action, real-world examples. Let's bring this to life with some real-world examples. Imagine you believe the euro is poised to strengthen against the US dollar. You could invest in a euro ETF that tracks the euro's performance. If your prediction holds true, the value of your ETF shares would increase, potentially generating a profit. Conversely, if the euro weakens against the dollar, the ETF's value would decrease. Or perhaps you're bullish on emerging markets and believe their currencies will appreciate. You could invest in an emerging market currency ETF that holds a basket of currencies from countries like Brazil, India, and China. As these economies grow, their currencies might strengthen, potentially boosting the value of your ETF. Remember, investing involves risk, and past performance is not indicative of future results. Section 5, ETFs versus traditional Forex trading, a clear choice for many. Now, you might be wondering, how do currency ETFs stack up against traditional Forex trading? It's a valid question, and the answer is pretty straightforward. ETFs often come out on top, especially for long-term investors. Here's why. Traditional Forex trading involves leverage, which can amplify both profits and losses. It's like riding a roller coaster. Thrilling, but risky. ETFs, on the other hand, provide a more measured approach, offering exposure to currency movements without the added leverage. Moreover, ETFs are incredibly cost-effective. They typically have lower expense ratios than actively managed mutual funds and don't involve the hefty commissions often associated with Forex trading. For investors seeking a simpler, more accessible and cost-effective way to participate in the Forex market, ETFs are often the clear choice. They provide the diversification, transparency, and ease of use that many investors crave. ETFs have taken the investment world by storm. They offer simplicity, especially in Forex investing. No more deciphering complex platforms or staying glued to screens. Forex ETFs let you trade currencies with a click, like stocks. No separate Forex account needed, no leverage worries. Imagine browsing Forex ETFs with your morning coffee. ETFs simplify Forex investing for everyone. Whether seasoned or new, ETFs are user-friendly. They remove barriers, letting you focus on informed decisions. One of the most significant advantages of ETFs is their transparency. Unlike some other investment vehicles that might seem like black boxes, ETFs provide clear visibility into their holdings. You know exactly what currencies your ETF invests in and their respective weightings. This transparency empowers you to make informed decisions. You can align your investments with your views on specific currencies or regions. For instance, if you're optimistic about the Japanese yen's prospects, you can choose an ETF that has a higher allocation to the yen. Moreover, you can track the ETF's performance throughout the trading day, just like you would with individual stocks. This real-time visibility allows you to monitor your investment and make adjustments as needed. This level of control is invaluable. It empowers you to stay informed and make proactive decisions about your Forex investments, rather than relying solely on external fund managers. Let's face it, investment fees can eat into your returns over time. That's why it's crucial to choose investment vehicles that are cost-effective. Fortunately, ETFs are known for their low expense ratios, especially compared to actively managed mutual funds. Expense ratios represent the annual fees charged by ETF providers to cover management and administrative costs. Lower expense ratios mean more of your investment returns stay in your pocket, compounding over time to potentially grow your wealth. Forex ETFs in particular tend to have lower expense ratios than traditional Forex trading accounts, which often involve commissions and other trading fees. This cost advantage can make a significant difference in your long-term investment outcomes. By choosing cost-effective Forex ETFs, you're essentially optimizing your investment strategy, ensuring that your hard-earned money is working smarter, not harder for you. Remember that old adage, don't put all your eggs in one basket? In the investment world, this translates to diversification, spreading your investments across different asset classes to reduce risk. Forex ETFs can play a vital role in diversifying your portfolio. By adding currencies to the mix, you're adding an asset class that often behaves differently than stocks and bonds. When the stock market takes a downturn, currencies might move in the opposite direction, potentially cushioning your portfolio from losses. Think of diversification as building a well-rounded investment strategy. It's like having a team of skilled athletes with different strengths and weaknesses. When one player is having an off day, others can step up and carry the team. Forex ETFs provide an easy and efficient way to diversify your portfolio across different currencies and regions, potentially reducing your overall investment risk and enhancing your long-term returns. Liquidity refers to how easily you can buy or sell an asset without significantly impacting its price. It's an essential factor to consider when investing, as it determines how quickly you can enter or exit a position. Fortunately, ETFs are known for their high liquidity, especially those that track major currency pairs. Forex ETFs trade on stock exchanges, just like individual stocks. This means they benefit from the high trading volumes and tight spreads typically associated with major stock exchanges. You can buy or sell ETF shares throughout the trading day at prices that are close to their net asset value, NAV. This ease of buying and selling makes Forex ETFs an attractive option for investors who value flexibility. You're not locked into long-term commitments and can adjust your Forex exposure as needed based on your investment goals and market conditions. While Forex ETFs offer a compelling way to participate in the currency market, it's essential to acknowledge the inherent risks involved. Just like any investment, currency values can fluctuate and there's always the possibility of losing money. One of the primary risks in the Forex is market volatility. Currency exchange rates can be highly sensitive to economic data, political events, and even investor sentiment. This can lead to rapid and sometimes unpredictable price swings, potentially impacting your investment returns. Another risk to consider is leverage. While we mentioned that Forex ETFs generally don't involve leverage, it's still crucial to be mindful of this concept. Leverage allows traders to control large positions with a small amount of capital, amplifying both profits and losses. While some traders use leverage strategically, it can be risky, especially for inexperienced investors. It's crucial to thoroughly understand how leverage works and its potential impact before engaging in Forex trading. Beyond the inherent risks of Forex, it's essential to be aware of risks specific to ETFs. While generally considered low-risk investments, ETFs are not entirely risk-free. One factor to consider is tracking error. This refers to the difference between an ETF's performance and the performance of its underlying benchmark index. While most ETFs strive to track their benchmarks closely, some degree of tracking error is inevitable. This tracking error can be caused by factors like fees, expenses, and the ETF manager's trading activity. While usually minimal, tracking error can impact your returns, especially over the long term. Another risk to consider is counterparty risk. This risk arises when the financial institution issuing the ETF, also known as the counterparty, defaults on its obligations. While relatively rare, counterparty risk can result in losses for ETF investors. Volatility is an inherent characteristic of the Forex market. Currency values constantly fluctuate, driven by a multitude of factors, including economic indicators, interest rate differentials, and geopolitical events. While volatility can create trading opportunities, it also presents a significant risk. Rapid and unexpected price swings can lead to substantial losses, especially for investors who are over-leveraged or caught off guard. Managing volatility is crucial for Forex investors. This involves diversifying your portfolio, using risk management tools like stop-loss orders, and staying informed about market events that could impact currency values. It's also essential to have a long-term investment horizon and avoid making impulsive decisions based on short-term market fluctuations. Remember, investing in Forex is a marathon, not a sprint. The Forex market is intricately linked to global events. Political instability, trade wars, natural disasters, and other geopolitical risks can significantly impact currency values. For instance, a trade war between two major economies could lead to a depreciation of their respective currencies as investors lose confidence in their economic prospects. Similarly, political instability in a country can trigger a flight to safety, causing its currency to weaken. Staying informed about geopolitical risks is essential for Forex investors. This involves monitoring global news, understanding the political and economic landscapes of different countries, and assessing the potential impact of geopolitical events on currency markets. It's also crucial to avoid concentrating your investments in regions or currencies that are highly susceptible to geopolitical risks. Diversifying your portfolio across different geographical regions can help mitigate the impact of these risks. As we've explored throughout this guide, the Forex market, with its vastness and constant motion, can seem like an intimidating labyrinth. However, like any worthwhile endeavor, understanding the fundamentals is key to unlocking its potential. Remember, knowledge is your most valuable asset in the world of Forex. By grasping the basics of currency exchange, the role of ETFs, and the inherent opportunities and risks involved, you've already taken a significant step towards becoming a more informed investor. The beauty of investing, particularly in the Forex market, lies in its accessibility. You don't need to be a financial expert to participate. What matters most is your willingness to learn, adapt, and make informed decisions based on your individual financial goals and risk tolerance. This guide has provided you with a solid foundation to build upon. Now it's time to put this knowledge into action and embark on your own Forex investment journey. Amidst the complexities of Forex trading, ETFs emerge as a beacon of simplicity and accessibility. They provide a user-friendly on-ramp to the global currency market, allowing investors of all levels to participate with ease. Think of Forex ETFs as your passport to the world's currencies, packaged neatly into a single tradable unit. You can diversify your portfolio across different economies, potentially benefiting from currency fluctuations without the intricacies of traditional Forex trading. From the ease of trading on stock exchanges to their cost-effectiveness and transparency, ETFs have revolutionized the way we invest in Forex. They empower you to take control of your financial future, making informed decisions about your Forex exposure without the need for specialized trading knowledge. As you delve further into the world of Forex ETFs, remember to research different providers, compare expense ratios, and choose ETFs that align with your investment goals and risk appetite. The Forex market is dynamic and ever-evolving. What worked yesterday might not work tomorrow. That's why continuous learning is paramount to navigating the currency waters successfully. Don't be afraid to dive deep into research, exploring different trading strategies, understanding economic indicators, and staying abreast of geopolitical events that could impact currency values. Embrace the learning process as an integral part of your Forex journey. Attend webinars, read books, follow reputable financial news sources, and consider joining online communities of Forex traders to share insights and learn from their experiences. Remember, the more you learn, the better equipped you'll be to make informed decisions, manage risk effectively, and potentially achieve your Forex investment goals. As we conclude this 25-minute guide to mastering FX investments with ETFs, remember that the journey of 1,000 miles begins with a single step. You've already taken that first step by educating yourself about the Forex market and the power of ETFs. Now, it's time to take the next step. Open a brokerage account, explore different Forex ETFs, and start investing with the knowledge and confidence you've gained. Remember, investing is a marathon, not a sprint, and consistency is key to long-term success. As you navigate the exciting world of Forex, always prioritize risk management, diversify your investments, and never stop learning. The Forex market, with its vast potential and constant motion, offers a world of opportunities for those who are willing to embrace the journey.